Good morning, ladies and gentlemen. Once again, I will be recording this exercise or question on the once again statement of cash flow, and I will be using the direct method. I will be recording later on next week another one on cash flow, which will be on the indirect method, where we also have to do the reconciliation note. So this question previously was named Toy Company. So I've just changed it to the name Happy Children. So Toy Limited was the original name. And the company is previously or is currently owned by family owners located in the Mpumalanga Plaza area of Middleburg. And when they exceeded their taxable supply by 150K in December 2020, they applied to be VAT vendors, and officially they were granted the certificate to be VAT vendors with the VAT number. However, one of the owners wanted to know what is happening to the cash of the organization, the whereabouts of the cash of the organization, because he wanted to buy a motor vehicle, but there was no cash available. So now you were appointed and requested to do an investigation. And the following information was extracted and became available for analysis of the statement of cash flow. Now we are required just to go straight to what we are required to prepare the statement of cash flow of LTD with notes. Most of the time I do ledger accounts instead of notes. At the end of the day, it is still called notes, but I'll be showing both the ledger account and how you can convert a ledger account into a note. So now I will be doing the statement of cash flow, analyzing the information that we are provided, and see how far do we go. I have already prepared the skeleton of the statement of cash flow, which is cash flow statement for the year ended 31st of December 2021. Very important to know the items that goes under each of the elements of the statement of cash flow. Remember, when I speak of the elements of the statement of cash flow, I'm referring to the cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So the first one of the cash flow for the year ended is the cash flow from operating activities. I don't know how I forgot this one. We have our cash flow from operating activities. So now cash flow from operating activities is where we begin. From operating activities. Then after we have cash received from customers, cash paid to suppliers and employees, the difference between the two will give us cash generated from operation. And the cash generated from operation come from the reconciliation note. You'll see that in the next recording. When we do the reconciliation note, which is the indirect method of doing the statement of cash flow. But now I'm doing the direct method, where I directly do the statement of cash flow as opposed to the reconciliation first. Then interest paid, interest received, dividends paid, and dividends received. If we do have dividends received, then after tax paid. Following there will be cash flow from investing activities. Then after cash flow from financing activities, and net increase or decrease, and your difference between your opening and your closing balance of bank. Now under our land and building, in the statement of financial position, is our land and building previous year. Remember, we are always given two comparative years when it comes to cash flow. The previous year 2020 and the current year 2021. And the previous year being 2020 becomes the opening balance of the year 2021 all the time when it comes to our assets and liabilities and equity sections. Then after we have current year will be closing balance of the current year, either asset, liability, or an equity section. So now when it comes to land and building, we are provided with note number 2, and you'll see that I made some few adjustments for those who have seen the original question here. There is no say note number 2. Let us see note number 2 and see what note number 2 has in store for us. No land and building bought or sold during the year. What does that mean? It means the difference between the 290,000 rands and the 320,000 rands is not because we have bought more land or building, is because of what is called the revaluation surplus. So the difference between 290,000 rands and 320,000 rands gives us 30,000 rands. So the 30,000 rands is the revaluation surplus. It is not a purchase of item of land or building or piece of land or building. So that is why I added that say note number 2 there, because it was not stipulated if that was revaluation or the purchase of the land. So now I realize that is very important to note. So now there is no purchase of land and there is no purchase of building. 30,000 is the revaluation surplus, and revaluation surplus gets to be recorded under your income statement under your other comprehensive income. Our equipment, very important to note the fact that it is recorded at a cost price in the statement of financial position. Then after, if we do have a cost price of equipment, then we ought to have also what we call accumulated depreciation for equipments. I think that should have been S there, for equipments or equipment, that is still fine. So now we do have a previous year 90,000 and current year 72,050 rands. So now that is our opening balance and closing balance of accumulated depreciation for equipments, because we are given equipment in our statement at a cost price. Previous year we had equipment of 190, current year equipment of 344,100 rands. Vehicle, same thing, our vehicles previously 150, current year 280,000 rands. Goodwill at carrying value, we did not sell goodwill. Normally goodwill remained there. It's not because we spent money. That's why the goodwill went to 12,000. Inventory from 54,000, 40,000 account receivables, and we have all these different accounts. Remember, your investment, your motor vehicle, your equipment, your land and building, they are under investing activities. They are under investing activities. Remember, we invest in assets, but when it comes to the investing activities, our focus is on non-current assets and short-term investment. If we do have short-term investment, that can be a current asset. But your cash flow from investing activities is your property sale or purchase, your land sale or purchase, your equipment or machinery purchase or sold, your vehicle that was bought or sold, or investment that was made. Either the investment sit under non-current asset or investment sit under current asset. That investment goes under your cash flow from investing activities. So now that being said, let us now leave that part. We have equity and liability as usual. Let us go now to our additional information, and according to each additional information we record. Now it says during the financial year ended 31st of December 2021, equipment with a cost price of 90,000 rands. Take note, equipment with a cost price of 90,000 rands, and this I also made an adjustment on it, was sold at a profit of 2,000 rands. And I also added the fact that the depreciation for the current year on equipment amounted to 9,050. So this is the depreciation on equipment for the current year. Depreciation on equipment for the current year. We are referring to two depreciations here. We are referring to the depreciation of the equipment for the current year, all from the beginning of the year up until the end of the current year. That is the depreciation. Now, for both equipment that is sold and the one that is not sold, because we have an equipment of 90,000 that was sold, costing 90,000. So that depreciation of that equipment is there in that 9,050. Now, let us record this equipment. We need to know now the selling price of the equipment. We also need to know how, if were there any other equipment that were probably bought or sold during the period. Now let us do the ledger account for equipment as our workings. Then we say equipment at cost, because our equipment is given or provided at cost price in the statement of financial position. This is an asset, and the opening balance of our assets is on the debit side, balance brought down 190,000 rands. Then after we have our balance carried down of an asset, 344,100 on the credit side. Then now, because our assets are at cost, we do not record depreciation in this ledger account. We do not record depreciation in this ledger account, but we record the cost price of the asset or equipment that was sold, because when we sell our assets, they have to decrease, and equipment decrease on the credit side, because assets decrease on the credit side and they increase on the debit side. So if we sell an item of equipment, it must decrease on the decreasing side of this account. Now that this has been recorded, once again, we do not record depreciation in this ledger account if the information provided regarding the asset is at cost price. But if this was carrying amount or carrying value, and this was carrying value or carrying amount, and this was carrying value or carrying amount, then we were going to record depreciation for the current year on the credit side. But in the case where that is not the case, then we only record the cost of the asset in the ledger account for that given asset. This is very important to master. Now we go to the total calculation. 344,100 plus 90,000 rands equals 434,100. 434,100 minus 190,000 rands. Now we see that the difference of 244,100 is on the debit side. This is an indication that we bought an asset of equipment during the year, and the price that we paid to buy this equipment amounted to 244,100. So now if we bought this equipment, then now we must come under cash flow from investing activities. Then I will say purchase of equipment or additions of equipment, purchase of equipment, because we purchased an item of equipment during the year, and this purchase of equipment amounted to 244,100 rands. So now let us go on that same note, and we go to the ledger account to see what is it that next we need. Now we need to know the equipment that was sold. If at what price was it sold for? We need to know the equipment that was sold, which costed 90,000. At what price was this equipment sold for? But before we can know that, we need to know the accumulated depreciation of the sold equipment. Accumulated depreciation of the sold equipment. That's what we need to know first. The minute we know the accumulated depreciation of the sold equipment, we will be able to say cost price minus accumulated depreciation is equal to carrying amount. Then the minute we get to carrying amount, we say carrying amount plus the profit on the sale of this. Carrying amount plus profit is equal to selling price. So now in this case, we need to open a ledger account called accumulated depreciation, where we will get to know how much is the accumulated depreciation for the sold equipment. Therefore, now let's come to our accumulated depreciation. Accumulated depreciation. Accumulated depreciation ledger account. This ledger account will help us to determine how much is the accumulated depreciation for the sold equipment. We have our balance brought down. We go to the statement of financial position to check how much is the opening balance of accumulated depreciation on equipment, 90,000 and 72,050. 90,000 and closing balance, it is 72,050. 72,050. So now we have to, on the credit side, record the depreciation of the current year. Remember, depreciation increases the accumulated depreciation. In other words, accumulated depreciation is the total of all the depreciations of the previous year, including the current year. We are accumulating the depreciations, hence it's called accumulated depreciation. 9,050. I think it was 9,050. So accumulated depreciation is the depreciations that have been accumulated over the years of the useful life of the asset. Every time we calculate depreciation, we accumulate or we add it to the account called accumulated depreciation. 90,000 rands plus 9,050 gives us 99,050. It gives us 99,050 minus 72,050. Then the 27,000 rands is the accumulated depreciation for the asset that is sold or for the equipment that is sold. So now the contra entry will say asset disposal. The contra entry will say asset disposal. So now in this case, this amount is the one that we're looking for, the accumulated depreciation of the equipment that was sold. If there was no equipment that was sold, the debit side was going to be equal to the credit side. So the amount of 27,000 was not going to be there as the difference. So now that we have discovered the accumulated depreciation for the sold equipment, therefore now we can say carrying amount of the equipment is the cost price of 90,000 rands minus accumulated depreciation of 27,000 rands. This will give us the amount of the carrying amount for the sold equipment, which costed the company 90,000 rands. So 63,000 rands is the value of this equipment on the date it was sold. So now we can say selling price of the equipment. Remember, this is cost price. This is accumulated depreciation. Selling price of the equipment will be 63,000 rands, which is plus the 2,000 rands. Remember, 2,000 rands is the profit that was made on the sale of this equipment, and said was sold at a profit of 2,000 rands. So now that means it was sold at a price more than the carrying amount by 2,000 rands. Whenever you make a profit, that means the selling price was bigger from the carrying amount by the amount of the profit. So we add the 2,000, then after that will mean that the selling price of this equipment was 65,000 rands. So now from this 65,000 rands, remember we sold an asset and we received money from the sale of this asset. Therefore now this will be called proceeds from the sale of equipment. Proceeds is the selling price, 65,000 rands. I forgot to put that in brackets because we made the purchase. When we buy, cash goes out of the organization. That indicates outflow of cash, so it becomes negative. In this case, 65,000 rands, we received money. We sold the equipment at a selling price of 65,000 rands and we received money. And I want to emphasize this, which I will explain in the next recording. I think it's in question 4, PK, that I'll be recording. The 2,000 rands is not cash. This is not cash, it's a non-cash item. When we sold the equipment, we sold it for 65,000 rands and we received this, and this increased our bank account. The whole 65,000 rands is cash that came into the organization. That is why in the statement of cash flow under investing activities, we recognize the entire 65,000 rands as cash that we have received, which is inflow of cash into the organization. However, the 2,000 rands, which is the profit, is not cash that we have received. It's a non-cash item. Why? Because we have already received cash. So now what we did, we said from the cash we have received minus the carrying amount of 65,000 rands, the difference of 2,000 rands is a profit, but the 2,000 rands, we have not received an extra money of that 2,000 rands. It is already part and parcel of that 65,000 rands that we have recorded in the statement of cash flow as proceeds from the sale of the equipment. That is why now in the next recording, when I do the reconciliation note, when it comes to the profit on the sale of an asset, the profit on the sale of an asset will be recognized as a non-cash item because we did not receive extra cash of that 2,000. However, it is already included in the selling price of 65,000 rands that we recorded as cash received or proceeds from the sale of an asset. That is recorded under the cash flow from investing activities. Now, number 1 is complete. Then we go to note number 2. We know that note number 2 spoke of the revaluation. We said the 30,000 rands, which is the difference between opening balance of the land and building, does not indicate that we bought item of land and building, but the 30,000 rands, if now there is an increase in the value of land and building, yet there was no purchase that took place, that means this is called revaluation. And revaluation, we do not receive money or we don't receive cash on the revaluation. It's when the property or the building gains value according to the market factors. So now because of that, there will be no cash inflow and cash outflow of the difference of the land and building from 2020 to 2021, which is 290,000 minus 320,000 rands. So now that one we leave it as is. Very important. I've added that note because it's very important. It was not clearly stated in the previous question. And it can be confusing when that is not clearly stated. So now let us go to the next one. Dividends declared during the period ended 31st December 2021 amounted to 35,000 rands. Dividends declared amounted to 35,000 rands. So now we go to our shareholders for dividends, 30,000 rands and 40,000 rands. Now I want to do the notes now. When we do the notes, we'll have shareholders for dividends. If you want to do the notes, shareholders for dividends, please write the for dividends as full. We get to have opening balance. That is how you write a note. Opening balance 30,000 rands. Then we have dividends that are declared. Dividends declared 35,000 rands. Opening plus declared minus closing balance. Minus closing balance. Closing balance is 40,000 rands. So the difference will be dividends paid. It will be dividends paid. So that is how you do the notes when you are required to do the notes. So it will be 30,000 rands plus 35,000 rands minus 40,000 rands. That gives us 25,000 rands. 1, 2, 3, normally 4 marks. It can still be less than 4 marks. So under your dividends paid, this will be 25,000 rands. Money went out. Now, if notes are not required, it is very important to show those workings here. Plus 35,000 rands minus 40,000 rands. So that you do get marks for your workings. Unless you have done the notes and we have done them very well and they are visible for marking your workings. Then we have recorded the dividends, and at the same time forget not that you can also do a ledger account for shareholders for dividends. I want to show you both of them. Shareholders for dividends. Shareholders for dividends. Under your shareholders for dividends, you would have your opening balance here. Remember, this is a liability account. Balance brought down is on the credit side of a liability. And a balance carried down of a liability is always on the debit side. That is 40,000 rands. On the credit side, we declared dividends. Dividends that are declared are a liability due to shareholders, and this amounted to 35,000 rands. Then from a ledger account perspective, you draw a line there in between. Then we get to 65,000 rands. We get to 65,000 rands minus 40,000 rands. That will give us bank of 25,000 rands. Same thing, together with your ledger account for equipment, you could have done a note on that. You could have done a note on the accumulated depreciation, but just make sure that your debit side is positive and your credit side is negative. So this will be plus, it will be opening balance minus asset disposal minus closing balance equals purchases of equipment. It will be opening balance minus asset disposal minus closing balance equals the purchases of item of equipment. So that is how you'll be dealing with that. But still, you'll be doing that in the same format. Opening balance minus asset disposal minus closing balance equals cash paid to buy an item of equipment. So now please be careful of that. You might be required to do notes for everything, not ledger accounts. Now we continue on that same note to the next adjustment, which is adjustment number 4. Adjustment number 4. What does it say? It says SARS normal tax for the period amounted to 173,950. 173,950. We are calculating SARS normal tax. Now let us do again the notes. We have SARS normal tax. SARS normal tax. Our SARS normal tax, we have SARS there, our SARS normal tax, opening balance 2,500, we have our opening balance 2,500. Remember, this opening balance was supposed to be on the credit side. Then we say taxation expense for the year. Taxation expense for the year, which is 173,250. Just verify. 173,950. 173,950. Then after we say less closing balance of 11,000 rands. Just verify, I think it was 11,000 rands minus 11,000 rands of the closing balance. Opening balance plus tax for the current year minus closing balance. That will give you tax paid. Taxation that has been paid to SARS. How much did we pay to SARS during the period? 2,500 plus 173,950. 950 minus 11,000. We see that we paid SARS 165,450. 165,450. This is the amount that we have paid to SARS. This is the amount that we have paid to SARS in terms of tax. And this 165,450 goes straight under tax paid. 165,450 indicated as negative money going out of the organization. Then after we go to impairment of SARS, we are told that cash paid to suppliers and employees amounted to 272,650. 272,650. The cash paid to suppliers and employees 272,650. 272,650 under cash paid to suppliers and employees. In the other question on cash flow that I previously recorded is called example 4, gripping gap, page I think 1237. Check that we were required to calculate this cash paid to suppliers and employees using the direct method, and there we were using the ledger account, and we divided our suppliers into two: the suppliers of inventory and other suppliers, those who supplied us with inventory and those who supplied us with other forms of supply. It could be electricity, it could be water, it could be maintenance. So we classified, but they were categorized under admin, operating, and distribution. But all of those admin, operating, and distribution, they were suppliers. It's people who supplied us with something. Therefore, now we paid them for that. And others were employees, and we paid them for their labor that they provided to us. So I explained that from a ledger account point of view, but in this case, they gave us already cash paid to suppliers and employees. So now what do we need? We need cash received now from customers. We first need to check how much is our sales. We need our cash received from customers. This one is done. This one is done. We're done with all others on top. Sales for the financial year end 31st December amounted to 800,000 rands. I did mention that in the previously, also emphasizing it, all your sales that appears here are credit sales. The minute you have a transaction that says sales, and we are also given cost of sales, but cost of sales here are not that much important for us to use them in any calculation. And we know that this amount will be recorded on the credit side of the inventory account in order for us to determine how much inventory did we buy on credit. And therefore now that difference goes to the credit side of the trade payables account in order for us to determine how much have we paid to our suppliers of inventory. I did that also in example number 4. I hope you are being reminded of all of that. Therefore, now we do have our sales which are on credit. So what do we need to do when we do the notes? Opening balance of debtors plus sales minus closing balance. Very easy. We have our trade receivables. Trade receivables. We have our opening balance. Opening balance the plus credit sales plus credit sales minus closing balance. This will give us cash received from customers. Cash received from customers. In the next recording, you will see there we take into account your interest income. We take into account your accrued expenses and your other components of trade and other receivables because they are available in that question. So please be on the lookout for that question. It will help you a great deal also to understand the other dimension. Now we have our opening balance. Our sales, we know that our sales are 800,000 rands. We are still looking for the closing balance and the opening balance of our trade receivables or accounts receivables. There is our account receivables, 40,000 rands opening and 65,000 rands closing. 40,000 rands opening and 65,000 rands closing. Then the difference will be cash that has been received from our customers. It will be cash that is received from our customers. On that same note, just verifying all the figures. Then we have 40,000 rands plus 800,000 rands minus 65,000 rands. Now 85,000 rands. This gives us 775,000 rands. 775,000 rands. 775,000 rands. So the 775,000 rands goes to our cash received from customers. Cash received from customers minus cash paid to suppliers and employees gives us cash generated from operation. 502,315. This amount, you'll get this amount under your reconciliation note. When we do the reconciliation note, I will link this amount with the reconciliation note and the direct method of doing the income, the statement of cash flow. Then after we are looking for the next transactions, just recording in the order of the adjustments. Then after we look at the remainder of the transactions, we are told that the total finance charges for the year ended 31st December amounted to 8,300. There is no other information stating how much was paid. Remember, 8.3 is the finance cost for the year. We might have paid a different amount. So if we paid a different amount in the statement of cash flow, we will record how much was paid. But in this case, the assumption will be that 8,300 was the interest expense for the year, and we paid the same 8,300 unless once again stated otherwise. Then we go to the next one, which is our income received. This one is very clear. They say income received. That means it is income that we have received on the investment, 8,500. But when it comes to the finance cost, it was not clear. And sometimes, once again, they can tell you that this is the finance charge or finance cost for the year, and they say interest paid was this amount. So on your cash flow, please only record what was paid. So now 8,500 was received as our interest income. So that one, there is no problem with it. We record it as is. And we covered the cash flow from operating activities. I would like to add in here the total minus 8,300 plus 8,500 minus 25,000 minus 165,450. This gives us 312,100. 312,100 is now our cash flow from operating activities. Cash flow from operating activities. We dealt with all of this. We dealt with our trade receivables. Yeah, here please watch the next question on our trade receivables, because we take into account your other incomes here. There is also other incomes that gets to be recorded here. Other incomes, which is receipt from clients, not only from customers but from all customers, including those we supplied them with inventory and those we supplied them with our money and they gave us interest on that. Your rent income will get to be recorded here. Your rent received in advance or interest received in advance gets to be recorded here. So now all those dynamics, they will get to appear in the next recording. Once again, please be on the lookout for that recording. And if you subscribe on my YouTube channel, you'll get all the notification as I upload the video. Now, the net profit before tax is important for the reconciliation note. When you look at the memorandum of this question, you will see that they did a reconciliation note. And in doing the reconciliation note, they get to an amount which is the amount that comes from our cash flow from operating activities, the one that we just calculated. After they have completed the reconciliation, they get to the cash generated from operation. They get to this amount using the reconciliation note, which is the indirect method of doing the statement of cash flow, is through the reconciliation note. And you'll see that they will get to this figure. So for this cash flow, I decided not to do the reconciliation note only because of saving of time. But the next one is a bit shorter. I will be doing the reconciliation note then after I complete the entire statement of cash flow. So we have covered now all that was provided to us in terms of the adjustments. So now what is next? What is next now is to complete the entire cash flow now. Is to complete the entire remaining part of the cash flow and look for items that are still remaining. Under investment, we dealt with the equipment purchase and the selling price of the equipment that was sold, which is proceeds. Now we need to check if do we not have other items of property, plant and equipment that were bought or sold during the year. Therefore, now let's check our vehicles. Our delivery vehicle amounted to 150 previous year, current year 280,000. Obviously, that means now there was a purchase of the item of the motor vehicle. There is not even a need for the workings there. There's no additional information. We can just say our vehicle was 150 minus 280. That will give us the amount of the vehicle that was bought during the year. 150 minus 280 is 130,000 rands. So 130,000 rands is the purchase of vehicle. Purchase of vehicle, which is a delivery vehicle. 150,000 rands minus 280,000 rands, which is closing balance, will give us 130,000 rands. 130,000 rands. It is the outflow of cash because we bought more motor vehicles. The minute assets are increasing, that means we bought more assets, then cash went out of the organization to buy that cash, then hence 130,000 rands indicates outflow of cash and negative. there is an investment, 20,000 to 30,000 rands. Our investment increased by an amount of 10,000 rands. So that will be investment made. When we invest, that means we're taking money from the business, we invest it somewhere else. And when we take money from the business and we invest somewhere else, that means cash goes out of the business to be invested somewhere else. So when investment increases, it means money went out. When investment decreases, it means we made a withdrawal on that investment. That means cash came into the organization as a withdrawal of that investment. So now these are the only items that affect our cash flow from investing activities. Once again, your cash flow from investing activities is your property, plant and equipment items, which is your land and building, your equipment, your machinery, your plant, your vehicles, and your long-term investment, which is under your non-current assets. And the other one that can be under your current assets, it is your short-term investments. If you do have short-term investments, that is under your current assets. That short-term investment also gets to be recorded in here under cash flow from investing activities. Depending to either money went out or in, that is something to deal with also. 244,100 plus 130,000 rands plus 10,000 rands minus 65,000 rands. We have 319,100, which is negative because the total of the bigger numbers is negative. That I think that should not be a problem at this level. Then we need to go to cash flow from financing activities. Cash flow from financing activities. Cash flow from financing activities, we need to check if did we have a loan that we made or we repaid? Did we buy more shares? Financing, we look at the shares that were bought or shares that were redeemed. Number two, you look at your loan. If did you take a loan and did you repay that loan? Those are the core things. If there are also debentures, take into account the debentures. If that gets to be there, debentures are under equity and debentures can be non-current liabilities and are non-current liabilities. So now we look at the equity and liability section. Just look around, other they are not. We look for the long-term loan. There we can see there's a difference. The ordinary share capital, we had shares that amounted to 260 and they increased to 320. 260 minus 320, that means we issued more shares. That means we issued more shares and people, they bought our shares. Hence now our share capital increased. So in other words, we received money from the issue of shares. Then this will be proceeds from issue of shares, and that amounted to 60,000 rands. 60,000 rands cash that is received from the issue of shares. Then after we come to the loan, remember again, when it comes to loan, you can have a short-term loan that will sit under your current liabilities. So if you do have a short-term loan under your current liabilities, strike the difference of that and record that accordingly in the statement of cash flow, either as short-term loan made or raised or else as a repayment of the short-term loan. So those are the current asset items, also current liability items that can affect the cash flow from financing activities. A loan was previously 140, it went down to 130. Obviously, that means we repaid. That's why our loan decreased. And the amount that we repaid is 30,000 rands. 140 minus 110 will give you 30,000 rands. So now this will be loan repayment. Loan repayment, 30,000 rands. When we repay loan, cash goes out of the organization to pay that loan. So now that will be reflected as outflow of cash in your statement of cash flow. 30,000 rands. Then after I will have our net increase or decrease in cash and cash equivalent. Net increase slash decrease, it will depend, but I want to do only one. Net, if it's positive, it will be net increase in cash and cash equivalent. And I think this cash is net increase of cash and cash equivalent. Let us see the difference. How do you calculate the difference? We only focusing on the cash flow from operating activity amount and cash flow from investing activity total amount and cash flow from financing activity total amount. Only the totals. We add and separate the totals depending to the sign of the one that you are dealing with. So now let us start with the one that have positive amount. The one that have a positive amount, which is our cash flow from operating activities, 312,100 plus 30,000 rands, which come from cash flow from financing activities. Then the total is 342,000. It is bigger than 319 from investing activities, which is negative. Then minus 319,100. This gives us 23,000 rands. So now the 23,000 rands is an increase in net cash flow. That means the total of cash that came into the business is more than the total of cash that went out of the business over the period of the current year we are busy with. Then that becomes net increase in cash and cash equivalent. Then now the second part, we're supposed to be on the same page. Please make sure that you don't do what I'm doing because of the limitation of space. Is there cash and cash equivalent at the beginning and cash and cash equivalent at the end? It is supposed to be here in the same page, not on the next page. Then now because of the limited space in my case, then we have cash and cash equivalent, cash and cash equivalent at the beginning and cash equivalent at the end. Now we're looking at the opening balance of bank and closing balance of bank. Opening balance of bank and closing balance of bank. Bank opening balance, nope. Bank opening balance was nil. Let's check the bank overdraft. Was not the opening bank there? The bank overdraft opening 12,000. This is negative. Remember, bank overdraft means we are owing the bank. We have unfavorable bank balance. So the opening balance is negative 12,000. Want you to note that it is in brackets, because it's an overdraft. If it was not an overdraft, it was going to be recorded as positive. Then at the end, how much do we have? At the end, we have an asset. At the end, we have an asset, and that asset is sitting at an amount of 11,000 rands. So that one remains positive. 11,000 rands. Now I like this one, because it goes back to what I previously emphasized. Now the rule says, take note, the rule says closing, which is end, balance at the end. The rule says closing minus opening. That is the rule. Closing minus opening. Now how much is our closing? Our closing is 11,000 minus. How much is our opening? Our opening is minus 12,000. Or let me do it like this. Remove the brackets so that it makes the mathematical sense. This is minus 12,000, but please don't use that minus 12,000. Use the brackets. I just want to do it for mathematical explanation. Now, the minus is this minus, which is the norm. Minus opening. How much is our opening? Our opening is minus 12,000. So now, if there are two signs, we put brackets. Then negative times by negative, it will give us positive. So now this becomes 12,000 positive, no longer negative, because the minus which come from the rule is there, and 12,000 is also minus. So minus times by minus gives you a positive. Then after we say 11,000 plus 12,000 is equal to positive 23,000 rands. And now if you look at the net increase, it is positive 23,000 rands. So these two must always balance. Otherwise, I don't think there should be a transmesh if you master my explanation. So now that is why in this case we get the same 23,000 rands positive as our net cash increase. Because one was going to say 11,000 minus 12,000. If you do that, you get to 1,000. And you wonder now why, and it's negative 1,000. Negative 1,000. You look at your net increase. Your net increase is 23,000. So now that becomes a problem in terms of the calculation. So hence I emphasize that is very, very important to note. Otherwise, guys, thank you very much. On my side, I have covered all that I needed to cover. Be on the lookout to revise this question and also other recording on the cash flow statement, and be on the lookout for the next one. Don't forget to subscribe on my channel. I need more subscribers, and tell your friends also to subscribe. Thank you very much.